Hello everyone, welcome back to the channel with another educational and informational video. Now in today's video, we're going to talk about the 3 reasons why an IRA or a 401k is not necessarily the best vehicle for retirement. That's exactly right. They're usually talked about as retirement vehicle, but I'm going to show you why that's not true. They're not good for retirement. All right, so let's dive into it as usual, right? The first reason is taxes. Next is market volatility. And the third reason is a lack of liquidity. Liquidity. You want your retirement vehicle to have these things not be an issue for you. So you don't want these to be an issue for your retirement vehicle, right? So let's talk about each individually. Taxes, the second biggest expense for everyone, excuse me. The second biggest expense. The first biggest expense is ignorance, right? Not knowing how to make $1 million, not knowing how to be financially free, not knowing the information. Not knowing could cost your life, cost you a lot over your lifespan, right? And then taxes, we pay taxes 5 to 6 times on the same money, right? It's like criminal. So taxes is such a big expense, and they push these vehicles as tax deferred, which they are, which means that you actually push the tax off to later. So you put money in and you don't have to worry about any taxes on the growth until later on. But think about this. When has anything that you procrastinate or push off to later that's important ever cost you less? Because that's what they say. Oh, it's going to cost you less. You're going to pay less later because you're going to be in a lower tax bracket. Not true at all. You're actually going to be in a higher tax bracket for 2 reasons. Mainly, number one, because you have less deductions later. Most likely the house is paid off. You don't have deduction there. You don't have dependents anymore when you're older, right? And you're probably not active in business anymore. So a lot of the things that you used to be able to write off or have tax break or tax relief on, you don't have that anymore. So you have to now pay more taxes on it, right? So that reason, and taxes are expected to go up. It's not expected to go down. With inflation and everything that's going on, printing money, all that, the people later have to pay for that, right? So it's not like it just goes away. That has to be paid for. So the way that the government usually have us pay for it is tax us more, right? So taxes are expected to go up more later, not less, all right? So tax is a threat to your retirement income. The next thing is market volatility. Your market goes up and down, right? Your money is actually invested in the market, whether it's a mutual fund or whatever, but it's invested in the market, which means you can lose money. So you're putting money in for retirement that you can lose. What that gives you? No safety. Now, why would you want a retirement vehicle that gives you no safety? The purpose of retirement is to have money ready for you, right? When you retire because you're not working anymore, stacked up so you can actually live the rest of your life with money to take care of you before your death, right? So you want that money to last you till your death, right? You don't want to have it in a vehicle that's not safe, right? So you risk actually outliving your money, and that's what's usually happen when you have money in this. Next is a lack of liquidity. Things come up in life. You want to be able to access your money that you put in for a rainy day, an emergency, or even an opportunity. If you get an opportunity to make more money and actually stack onto your retirement money, you should be able to access this. But you cannot, because the government is actually the owner of this, not you. It's for your benefit, but the government is the owner. And the government tells you when you can touch it and when you can't touch it. So before 59 and a half, if you touch it before that, in addition to the taxes that you're going to pay, you're going to be hit with a 10% penalty. All right? You're going to be hit with a 10% penalty. You can't touch it before 59 or else, and a half, or else we're going to not only tax you but penalize you. Now the whole reason for having money sitting in a retirement vehicle is to have it grow and continuously and not interrupt. So these things interrupt your money, right? Because it's lessening what you actually have in there. Taxes takes a big chunk. If the tax is 35% and you have 100,000, that's 65,000, right? You really have $6.50 out of every $10, right? And with inflation, you need to have more money to spend, not less. So you're working the opposite way right here, because things are going to cost you more later. So you want the money to just continuously grow more because of that reason. So with taxes, that's going to lower what the money that you have in there. And then with market volatility, with your money going down, imagine like in 2008, where if you had $1 million in there and then you look and it's almost 600,000, that's a hard pill to swallow. This is your retirement money. You don't need to be worried about it or worry about losing any of it, right? So market volatility don't help you, right? So these two things is your problem, main problem when it comes to that, right? And again, lack of liquidity. But you want uninterrupted growth, right? So instead of having your money interrupted with taxes and market volatility, you want uninterrupted growth. You want this. It's constantly going up, right? You don't want this. You don't want that, right? It's still growing, but it's not growing like it should be, because at some point you have losses as well. So when you lose and you drop down, you have to work so much harder to get back to where you are and past it, right? You don't want that. You want the money to just gradually keep going up and 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 up, right? That's what you want, right? So you can combat inflation. All right, so having said all that, right? Me saying taxes is going to hurt you, it's a threat to your retirement money, market volatility, and having not being able to access it so you could, use it for whatever you need to use it for. So if that's not good, then what's the solution, right? That's the problem with it, right? So having said all that, what do? I would say a cash value life insurance will be the best thing to use for a retirement vehicle. All right, so cash value life insurance, LI for life insurance. All right, there's two kinds you can get. You can get like a regular, what's called a whole life, or you can get an IUL, Index Universal Life. Okay, they're both cash value life insurance, meaning they produce cash value. They produce, the policy not only gives you a death benefit, but it produces a cash value so that you can utilize that or do whatever you need to do with it. You can borrow against that cash value in case of emergency, right? So we're going to solve the three problems that we have, all right? So the problem that we had was taxes, and the problem that we had was market volatility and liquidity. So this solved all those three problems. All right, so let me just tell the difference between these two real quick. Again, they both build cash value, right? But a whole life gives you a guarantee, all right? So they might say we'll give you a guarantee 4% growth or 5%. So it's going to grow uninterruptedly. There's no taxes or market volatility that's going to affect it, right? It's not invested in the market, and you don't have to worry about that. It's safe, right? Then with an IUL, also builds cash value, but the interest is credited differently. This interest is tied to an index, like the S&P 500, but it's not invested in it. So you get to participate in a higher growth. So an IUL will give you a higher growth potential in exchange for no guarantees. All right, so no guarantees, but you still don't lose. So you can participate when the market goes up in some of the growth, which gives you a higher growth potential than the whole life. But then if the market goes down, you get nothing. All right, so that's what you exchange for that. So that's it. But you can use either of that. But both of them, right, or A, don't pay taxes. You can actually grow the income inside of it. Whatever it's growth, whatever growth, any money you put in as premium payments and any money that was added from interest earned or growth, tax free. Not tax deferred, tax free. You can borrow against it as well. So unlike with the 401k and IRA, when you said you want to touch it before 59 and a half, they penalize you. You don't get any penalty here. You can borrow against it and you get no penalty, and you could do it at any time. It doesn't have to be till 59 and a half. It could be when you're 30. It could be when you're 35, 40, whatever. So it solves all those three problems. No taxes when on the premium you put in, no taxes on the growth, no taxes for borrowing against it. And when you also have a death benefit here. So when you transfer it to your heirs, it's going to be tax-free. So not only are you able to utilize income in retirement, okay, but when you die, there's also a death benefit. So you're living, you use it for retirement, living, and you enjoy that money that you saved up or you put in there all that time. And when you die, you still pass on a legacy to your family. I mean, this is 10 times better. It solves your problem, plus it gives you more. All right, so that would be the solution. Now, as always, if you do like the video, you think the information was valuable, make sure you like, make sure you comment, make sure that if you have a question, leave it in there for me. I'll be sure to answer every question for you. And if you haven't already done so, please subscribe to the channel. It doesn't cost you anything. And share it with a friend, right? And hit the notification bell so whenever I drop a video, you're one of the first to be notified. Until next time, see you soon.